Hello everybody, it's Magnus Brandforce with Stellicum Investments. My broker-dealer is Commonwealth Financial and my clearing firm is National Financial Services, a division of Fidelity Investments. Today is March 22nd of 2021, exactly 1 year removed from the bottom of the markets of the COVID pandemic financial crisis of 2020. And today's subject is going to be about diversification and tactical allocation. So diversification is a word that even the most elementary do-it-yourself investor is familiar with. Diversification. The most common concept of diversification is balancing risk and opportunity by increasing the number of different securities that you hold. But that form of diversification is relatively juvenile because it is not just about the number of investments. If all of the investments are the same, it may not really be diversified. There were people, for example, in 1999 that thought they had a diversified investment portfolio because they owned 20 different technology stocks. Well, 6 months, 7 months into the year 2000, they had declined 80% when the broader market was maybe down 10%. So, diversification is far beyond these days of what the concept of diversification even used to be, 30 to 70 years ago, where the concept of diversification was, the allocation between stocks, a number of stocks, bonds, and cash. As the world became more financially sophisticated, there become more and more financial instruments, classifications, and instruments for a investor to make money, lose money, diversify, and over the years, people brought up the fact that perhaps you should have commodities, precious metals, and things like that as diversification. Certainly real estate. Real estate became a part of asset allocation as from the 1950s and onward, real estate became a more and more popular investment vehicle. Now we even have these cryptocurrencies as supposedly a form of investment that everyone needs at least some of. It's good diversification. And 10 years from now, 20 years from now, we can't even imagine what might come next. I mean, who would have imagined crypto? I mean, it was just a concept that's come up here in the last, within the last 10 years. So, starting with the major areas of investing, let's talk about stocks. Just as an example, with stocks, when it comes to diversification, you've got large companies, medium companies, small companies, and micro companies. There are fast-growing companies that are long on promises and have yet to quite deliver yet. There are value companies that are tried and true that pay dividends. So there's the diversification between growth and value, and the performance can be very different from each other in various time periods. As an example, post-economic crisis 2009-8, value stocks dramatically led the way out of that big economic downturn, only to then in about 2013 or 14 pass the baton on to growth stocks, and growth stocks have led their way all the way now till October, and now value stocks are appearing to take the charge. So there's a difference of types of stocks. There's also different kinds of stock industries, and they have different type of characteristics in different markets. For example, consumer staples, grocery stores and aspirin companies and products involved in the manufacturing of consumer paper products. Those are companies that are non-cyclical, everyone needs them, and sometimes they perform better. And then there's periods of time when people would prefer to have consumer discretionary companies where people are intentionally spending money because the economy is good, making those companies more favorable. And going beyond that, there are foreign companies. And these foreign companies can be in developed economies or in emerging economies. And the world's stock market today has become so big that the United States is no longer this secular place where you should be investing. It would be foolish to not have diversification overseas for two reasons: risk management and return opportunity. Anytime you introduce foreign securities, though, you are adding a new kind of volatility, which is the currency risk. For example, if you have a portfolio of German stocks that decline by 10%, but the European currency were to decline 10%, well, now you've lost 20% because it has to be converted into today's U.S. dollar as a U.S. investor. So you can get a tailwind or a headwind from currency. In the bond market, there are corporate bonds issued by businesses. There are municipalities, local governments that issue debt, which is tax-free interest. And then there's the federal government bonds, and that too is foreign and domestic. Then there are loan instruments that now publicly trade. They can be very volatile. They can be of very low quality or very high quality. They can offer significant yield advantage at very times to higher quality bonds. These are often referred to as junk bonds. And junk bonds have that name for the fact that they have acted like junk in the past, but they have made gold for people on economic recoveries. So bonds are an important part of diversification. Trouble today is in today's world, with extremely low interest rates all across the globe, one might ask, if I'm buying an instrument that's only paying 1, 2, or 3% interest, but has as much as 20 or 30% downside in 1 year, is that really a risk-reward scenario that I'm comfortable with? So somebody said, well, you can shorten the maturities. You can shorten or compress the risk by going into shorter term securities. So bonds are typically issued anywhere from 1 to up to 30 years. There are actually some financial instruments that are perpetual, and there have been bonds that have been issued for beyond 30 years. But very complicated financial instrument that has its risk and rewards. Ever since interest rates were being lowered in 1982 to now, we've been in a downward interest rate trend, and it's the longest trend in the history of our country at this point. There's been a tailwind. Your bonds have been paying you, and the prices of the bonds have been going up at the same time. And so people today feel very comfortable with bonds. The last major crisis that had a dramatic impact upon the public and caught people off guard that I can recall was early in my career in 1994 when Alan Greenspan raised interest rates 8 times. Volatility in the bond market right now has been rather tame, other than junk-oriented bonds, which suffered a fair amount during the 2020 downturn. There was actually an opportunity to buy fixed income during the middle of the crisis. Prices of those, went down and have now rallied very, very sharply. Again, in fact, there are investment portfolios of fixed income instruments that in the last 12 months are up as much as 80 or 90%. So fixed income has a very complex nature to it. Now, the whole point of diversification is sometimes lost on people, and that's one of the reasons why I've dedicated myself to producing this video. Diversification should really start, especially for my clientele, which are senior citizen retirees that are looking for investment income from interest and dividends from their portfolio. Diversification starts with risk management. The reason why you're diversifying is to protect yourself from a significant economic downturn or potential for permanent loss. So that means your investment instruments should not be the type to be going up in unison, because you don't want them all to go down in unison. It's called correlation. You want assets that don't necessarily work in tandem with each other. It used to be that people believed that stocks would go one direction and bonds would go another direction. That is not always the case. And in modern history, bonds and stocks have seemingly worked in a very similar direction. Granted, U.S. Treasuries in the last few major economic downturns have indeed outperformed every other kind of asset in a liquidity crisis. So U.S. Treasuries can be that safety net. But it is folly to believe that just because you have stocks and bonds that you're somehow insulated from a downturn through diversification, because depending upon what kind of bonds you do own, they may or may not participate in the economic cycle that is negatively affecting stocks. So reverse correlation is part of an investment portfolio. And while that sounds good now, the trouble is investors tend to open their statement and they tend to gravitate eventually to, well, what's not doing well in my portfolio? Well, geez, maybe we should get rid of it. You know, I got these things that are doing well, but these things are doing poorly. Maybe we should sell these and find something that's doing better. Well, now you're defeating the whole purpose of a truly diversified portfolio. Now, there may be reasons for the underperformance of a specific security that may warrant you to want to sell it, but maybe that should have been addressed when you bought the security. My way of dealing with underperforming securities is I think I did my homework beforehand, I didn't buy too much of it, and I'll wait until things turn around. So that, again, that's a kind of thing you do beforehand. Now, in a perfect world, or a normalized world, which we don't seem to live in, asset allocation, spreading out investments through various different types of investments and percentages and categories and things like that, you'd be able to kind of come up with a model and put that money to work and then completely leave it alone. The problem is some things today are bargains. Some things today are not bargains. They look extremely overpriced and perhaps should be sold or not bought, and then various things in between. So putting money today to work in a properly diversified asset allocation portfolio obviously needs to take in mind where's the best bang for the buck. What can I buy that's low enough priced where the risk is maybe low and the upside's high, while avoiding the risk of putting a lot of my capital to work in something that's kind of expensive or overestimated only to have a significant downturn in the future. So diversification and asset allocation are they are a changing thing. Now, does that mean you day trade your portfolio? No. Substantial changes to asset allocation, I am generally making reasonable sized moves, typically maybe every 6 months, maybe but once a year. In a volatile market, maybe perhaps from what we've seen over the last 18 months, there may have been a need to make some adjustments for opportunity or risk management, along the way. But I would say that, this process of monitoring an asset allocation in a decent-sized investment portfolio is something that is going on about every 6 to 12 months in a bigger way. Now, if somebody has a significant amount of capital and doesn't have a tremendous amount of investment experience, a problem that I've seen with many people in my 30-year career dealing with people, thousands of clients over the years, is that generally speaking, no matter who they are, a good way to start with this large sum of capital is to start conservatively. In my experience, most people seem to have a lot of cash when the economy is healthy and strong, and therefore the prices of everything seem to be relatively high. There's a greater risk of things going down than the potential of things going up. So by starting conservative, a person can create a portfolio of investments that can later be allocated a little bit more aggressively or growth-oriented after bargains present themselves. Also, as a professional investment advisor, it is important that I get to know the client a little bit and see what type of personality they have as an investor. a person may say that they're aggressive and they're not. Another person may say they're extremely conservative, and the truth is they're not. So my job as an investment professional is to get to know the client, so I'm in tune with that to a degree. So as the markets are changing all the time, you know, when there are opportunities to sell investments and take a good profit because things have really panned out as you expected them to, generating cash, I want to redeploy that money by buying low so I can later sell high. I am not going to be chasing after the hottest investments of the day with that cash, because as a professional investor with a long history in the market and an astute studier of financial history, there's too much risk with that. So I allocate as a bargain hunter, not as a speculator. Today, the market has had a dramatic recovery. I mean, in the last 12 months, returns look, pretty spectacular. And at this point, a person that's done very well and had massive recovery off the bottom here, to a degree, people may be saying to themselves, you know what, maybe I should be reallocating my portfolio a bit more conservative because I want to normalize how my portfolio was structured. I was pretty aggressive there at the bottom and made a lot of money, and now I want to take my risk scale down from say 1 to 10, from a 7 down to a 5 or something like that. Likewise, one would hope that going into a significant market downturn, there were some telltale signs that there might be some trouble, and so you had allocated the portfolio rather conservatively so that when the market does go down, you have enough opportunity within your portfolio to put some of your money to work in things that have gone down a lot, and become bargains. So that's part of the tactical side of reallocating the investment portfolio. If everything has been aggressively invested and you're down a bunch, you really don't have any dry powder to put to work. Obviously, if you have cash that you don't need, you may put that money to work. So, it is textbook-wise, the stuff seems very easy and maybe makes a lot of sense here, but there's always the emotional side of things. When things go extremely bad, many people who aren't professionals, they struggle with the idea of potentially throwing good money after bad. Things are frightening. People are loath to want to invest when there's uncertainty and trouble. Well, but that's when the bargains are. So as a financial professional, my job is, just because the market's terrible and unpleasant, I still go to work and I still have to do my job, and I will allocate money with a certain element of discipline. But there does come a time, and it certainly did come with this COVID crisis, that there was an enormous amount of uneasiness by investors and professional investors, and that is simply part of investing. Fortunately, those episodes, there's a long history of that going back throughout the history of finance. Fortunately, they don't last forever. And here we are on the other side of COVID, just a year later, and there is what looks to be a better looking future for everyone, not just in the United States, but around the world. One area of diversification that has always kind of driven me crazy, whether it's within our industry or just hearing people talk, is something called diversification. That is where you excessively diversify a portfolio to the point where there may not be much upside to it. Warren Buffett believes that is a sin of many investors. So that's one term for the word diversification, is that by having such diversification, you can't make significant rates of return. Now, my clients are not looking to get rich. They are trying to avoid being poor and get a reasonable rate of return over time. So for a young person, one way to get rich is to buy some very good investments, put a decent amount of money on them, let them grow, and then as they grow, they become a substantial percentage of your portfolio, which could be considered risky, but that is how wealth can be created. Many people do become wealthy in the stock market because they bought a great company of today many years ago when they were small and let it grow and blossom. There will come a time where a person has to have the discipline to downsize that, but that's a bit of a different story. I am not a fan of senior citizens having anything more than about 10% in any one stock. I have seen too many times in my career, even extremely reputable, well-known companies make a turn of events and have downturns of, up to 100%. United Airlines went bankrupt, General Motors, Washington Mutual, a bank I used to work for, AT&T and all of its subsidiaries, they declined by 85% in short order. So having an excessive amount of money in one stock as a senior is not a good idea. The other, and on a final note about diversification, and namely diversification, is that people in the market and the marketeers in the product world are always convincing people, hey, you should buy this because it's good diversification. You should add it to your portfolio. Well, they always say that when it's trading at an all-time high or it's the hot new thing or new and improved. If you are going to add something, if that does make sense that you should have, I don't know, years ago as commodities were red hot, well, then wait till the prices normalize, then put it in your portfolio. But if you decide to add those securities at the top of the market, it can have it's just going to have a negative effect. So be leery of being told or advised to add something out of the ordinary into a portfolio simply because it's good diversification. It more than likely is diversification. So there are so many different elements to diversification and tactical allocation, and it is an ever-changing field, a big and responsible part of my job here that I enjoy and I follow on a nearly daily basis. So thank you for watching the video. If you enjoyed it, please hit the subscribe button and share my video with somebody else. Until next time, many happy returns.